And Consumer Protection Subcommittee hearing to order. Good afternoon, and welcome to today's hearing entitled Ensuring Fair Access to Banking, Policy Levers and Legislative Solutions. I want to thank Ranking Member Cortez Masto, this is our first hearing, for working with me to hold this hearing, and for the witnesses and your willingness to testify and to do the preparation that's necessary before this hearing. Law-abiding Americans and U.S. businesses deserve to be banked, full stop. Every day, Americans and U.S. companies rely on core banking services, deposit taking, checking, lending, and transaction processing to go about their daily lives. When access to these services are denied, not because of risk or creditworthiness or illegal activity, but because of politics, religious beliefs, or involvement in a legal but disavowed industry, we have a serious problem that demands congressional action. Debanking exists for two primary forms. The first happens in open and in an easy way to spot. Financial institution initiated debanking, and that occurs when a bank or a credit union voluntarily reduces or outright severs a banking relationship as a part of a political calculation, or maybe from board pressure, activist board members. Often, this action occurs in the face of activist pressure, and U.S. energy companies, firearms manufacturers, and dealers and digital asset companies have borne the brunt of this harmful practice over the recent decades. The second form, regulator-initiated debanking, is more opaque and, I think in many ways, more sinister. Using the regulatory apparatus at their disposal, prudential regulators pressure, coerce, or direct financial institutions to terminate relationships with certain customers or industries. Infamously, Operation Choke Point under the Obama administration saw the Department of Justice and the FDIC systematically target firearms dealers, ammunition retailers, payday lenders, and other legal businesses they found politically objectionable. More recently, the Biden administration deployed a similar playbook against the digital asset industry in what many called Choke Point 2.0. Both forms of debanking share common threads. They use our financial system as a tool to enact policy outcomes outside of our democratic process. Legal U.S. companies and their employees are harmed, and public confidence that our banking system remains independent from passing political whims is eroded. These three are outcomes we should seek to prevent, not allow. That is why I released the discussion draft of the Ensuring Fair Access to Banking Act of 2025, which takes a comprehensive approach to ending politically motivated debanking. The legislation rests on three pillars. First, it establishes a strong federal fair access standard that prohibits denying core banking services based on First Amendment protected activities or the business type of a legally operating enterprise. By enacting this standard, Congress would provide regulatory clarity and uniformity for customers and financial institutions nationwide. Importantly, the bill preserves the bank's legitimate financial and risk management discretion through exceptions for safety and soundness, profitability considerations, risk assessment, and ongoing compliance with existing laws and regulations. Second, my discussion draft permanently repeals the use of reputational risk in examination and supervision. By incorporating Chairman Scott's FIRM Act, we can ensure that regulators no longer use this amorphous standard to pressure banks into debanking customers that a future administration disfavors. Third, the legislation implements targeted reforms to bring transparency and accountability to the examination process. It allows select members of Congress to request confidential supervisory information, giving us the ability to conduct meaningful oversight of examiner conduct. It also creates a special inspector general within the Treasury Department to receive and investigate allegations of regulatory abuse, ensuring that when examiners overstep their authority, there is a meaningful avenue for accountability. Finally, the bill modernizes outdated anti-money laundering thresholds that haven't been adjusted since the 1970s and the 1990s. These hard caps, when leisure suits were popular and gas was about 49 cents a gallon, now capture routine transactions and increase the likelihood that ordinary customers are misflagged for account closures over standard lawful activity. Taken as a whole, the Ensuring Fairness Access to Banking Act of 2025 represents a systematic approach to addressing the dual forces in debanking and regulatory levers that have enabled it to occur. I want to thank our witnesses today for joining us to discuss these important issues. Your testimony will help inform our work as we move this legislation forward. I look forward to a productive discussion about how we can ensure every American, regardless of their politics, their faith, or their profession, has fair access to banking services they need to participate in our economy. At this point, I'll turn to Ranking Member Cortez Masto.
Thank you, Mr. Chairman. Thank you for convening this hearing today. I bet you at one point in time had a couple leisure suits that you owned.
I
Is that
did.
right?
I really rocked a blue tuxedo.
I
Thom,
bet.
too.
Thank you. I want to thank the witnesses as well. Thank you for being here. Look forward to the conversation. We are here today to discuss strategies to improve access to necessary banking services. Here are my three priorities. Provide low-cost basic banking services to the American people. Ensure that our bank regulators are independent, adequately staffed, and that our financial institutions are safe, sound, and protecting consumers. And enact the Safer Banking Act to provide banking services to cannabis businesses in the 40 states and Washington, D.C., where cannabis is legal. Now, we have to expand banking services to the 19 million people who are underbanked and nearly 6 million people who do not have a bank account. In Nevada, we rank 8th in the nation for unbanked households. More than 6% of the households in my state do not have a bank account. Without a bank account, these families struggle to pay bills, cash a paycheck, and save up for future expenses. There are many reasons people can't access a bank account. Sometimes people may not have enough money to meet a bank's minimum balance requirement. Sometimes they cannot afford to pay high or unpredictable overdraft or non-sufficient fund fees. And sometimes they are a victim of a scam that requires them to file for bankruptcy. Without access to a bank account, many Americans are forced to use expensive alternative financial products. Just a couple of months ago, President Trump issued an executive order that he claims would guarantee fair banking for all Americans. Despite its name, the executive order would not help the 25 million Americans who are unbanked or underbanked. Instead, what it does is it guts the cops on the beat who protect people from unfair, deceptive, and abusive bank practices. The president is destroying the Consumer Financial Protection Bureau, which leaves people without an agency to respond when they feel they have been unfairly treated. The Consumer Financial Protection Bureau has ensured consumers had access to fair and transparent financial products for more than 14 years. That's why I have a bill, the Stop the Scammers Act, to restore the CFPB's funding. If we want to make sure that all Americans have a fair access to banking, they also need fair access to consumer protection. The other topic I want to talk about today is state legal cannabis businesses who I hear from in Nevada all the time because they are struggling to get access to financial services. There are so many Nevada business owners who have opened legal cannabis businesses and created jobs across our state. Last year, Nevada's cannabis sales brought in $829 million with $120 million in taxes. These businesses and their employees should be able to access the same banking services as all other businesses. In September 2023, the Banking Committee passed the Safer Banking Act. The House of Representatives has passed SAFER numerous times. I hope we bring the Safer Banking Act to this committee again and finally pass it into law in the new year. Even if the president reschedules marijuana, that will not address the limits on banking services that are harmful for our Nevada cannabis growers and retailers, as well as others in the cannabis industry across the nation. In 2026, I hope we hold more discussions on addressing banking by cannabis businesses and strengthening consumer protection. Thank you.
Going to do the witness introductions and then hear your opening testimony. First, we'll start with Dean Julie Hill, currently serves as the University of Wyoming College of Law Dean and Excellence Chair. Prior to that, she was Vice Dean and Alton C. and Cecil Cunningham Craig Professor of Law at the University of Alabama School of Law. She also serves as a faculty member at the University of Houston Law Center with more than 24 articles examining unwritten rules of banking regulation. Dean Hill is known for her expertise in banking and commercial law and is a frequent commentator for national media outlets, including American Banker, Bloomberg, NPR, Reuters, and Wall Street Journal. And Ms. Hill, why don't you begin your statement?
Thank you, Chairman Tillis, Ranking Member Cortez Masto, and members of the subcommittee. Thank you for asking me to testify on debanking today. While my area of legal specialty is banking regulation, and for the last 17 years I've studied and taught and written about banking as an academic, I also have some practical banking experience. Prior to becoming an academic, I practiced law in Washington, D.C. at Skadden Arps, Slate, Meagher & Flom, where I represented large financial institutions. And before I was an attorney, I worked at community banks. While I'm currently privileged to lead the only law school in the state of Wyoming, I'm here today as a subject matter expert, and so the views that I express are my own and not necessarily those of the University of Wyoming, its College of Law, or other organizations with which I have been affiliated. Access to banking is important. It enables people, organizations, and industries to participate in the economy. Debanking, that is the closing or withholding of accounts for reasons unrelated to violations of law, financial risk, or business purpose, threatens access to banking services. Debanking, for example, occurs when a bank closes an account for political reasons. This, of course, is not the first congressional body to examine debanking. Beginning in 2014, there were hearings surrounding Operation Choke Point. At that time, Congress was examining allegations that the Department of Justice, the FDIC, and other regulators pressured banks to cut off services to payday lenders. More recently, hearings have focused on whether the crypto industry, the firearms industry, immigrant groups, and others have been debanked. One thing that is apparent from all of these hearings is that there is disagreement about why banks are closing accounts. Are banks being pressured by government supervisors to cut off disfavored groups? Are banks unilaterally imposing their own political preference? Or do banks have legitimate business purposes or financial reasons for their account decisions? Some believe that debanking is a large problem, while others dismiss it as a conspiracy theory. Well, I think that it's important to investigate how often debanking happens and why. I believe that persistent allegations of debanking alone are enough for Congress to consider regulatory reforms. A stable banking system relies on public trust in government bank supervisors. Debanking and persistent rumors of debanking undercut trust in bank supervisors. Let me explain why. Banks, like a lot of businesses, depend on trust. But unlike other businesses, banks do not have good ways to signal that they are trustworthy. Suppose you want to buy a refrigerator. You know that some refrigerators aren't going to work properly. The manufacturer worries that if you think you're going to get a bad refrigerator, then you're not going to buy one. So what the manufacturer does to solve this problem is they offer a warranty. If the refrigerator turns out to be bad, the manufacturer will replace it, and as long as only a small number of the refrigerators turn out to be bad, you can trust that you're going to receive a good refrigerator. Banks, however, are not like manufacturers. When a bank has financial difficulties, all of the bank's deposits are in peril. Because banks lend out money, they don't have a good way to allow for a sudden increase in withdrawals. And we end up with a situation very much like the one depicted in the classic Christmas movie, It's a Wonderful Life, where there's a bank run. A run can spread to other banks, causing a banking panic. Runs and panics have the potential to destroy even solvent banks by making them liquidate assets at fire sale prices. This is bad. Instead of expecting banks to rely only on their own reputation, our supervisory framework prevents runs and panics by allowing banks to rely on the trustworthiness of government insurance and government supervision. We trust banks because we trust government supervisors who keep an eye on them. If debanking or rumors of debanking cause the public to view government bank supervisors as politically polarized, the supervisors lose some of their credibility. Banks may also be less forthcoming and less willing to cooperate with regulators. This has the potential to destabilize banking and contribute to runs and panics. There are two features of the banking regulatory system that prevent government supervisors from credibly assuring us that debanking doesn't occur. First, bank regulators have discretionary supervisory power to engage in debanking. Using reputation risk or other supervisory tools, bank examiners have the power to influence bank decisions for political reasons. Banks have little recourse when bank supervisors stretch their authority. Second, bank regulators' supervisory actions are largely secret. This means that those alleging government debanking rarely have proof of the reasons that their accounts have been shut. But it also means that bank supervisors have a difficult time convincing the public that debanking doesn't happen. My testimony examines these two features. First, although bank regulators have assured both banks and the public that they don't pressure banks to debank customers, they have been unsuccessful in stopping persistent debanking concerns. The regulatory disavowals lack persuasive power because they are inconsistent with the discretion that bank supervisors claim. Banking agencies claim broad power, including power that would allow them to force debanking, but they ask the public to believe that they don't use that power. In many cases, the banking regulator's power is so broad that banks have little opportunity to challenge it. Of course, some discretion is necessary for supervisors to exercise professional judgment, but other supervisory discretion serves little purpose other than giving supervisors authority to impose policy preferences tangentially related to banking safety. Congressional testimony is not the time or place for a complete catalog of overbroad supervisory discretion. Instead, I want to highlight two areas where regulators appear to have used their discretion to influence debanking. The first is reputation.
Ms. Hill, if we could be mindful of time, if you could wrap it up. I definitely want your written testimony in the record. Thank you.
So the first is reputation risk, as you noted. The second is broad supervisory discretion in terms of the management rating. So banks get rated on the CAMELS factors: capital assets, management earnings, liquidity, and sensitivity to market risk. One of those is management. When determining the management rating, supervisors evaluate whether or not banks respond to recommendations from their government regulators, and this gives them broad authority to pressure banks to debank customers, and that's, we think, part of what happened with Operation Choke Point 1.0. The other part of this that leads to debanking is, of course, secrecy, and it's very hard to get information out of financial regulators, and it's actually illegal for banks to provide information about why they've closed accounts. And so when we have this broad discretion coupled with secrecy, it makes it very hard for regulators to credibly say to us that debanking doesn't happen. So in conclusion, debanking and rumors of debanking have plagued the financial system for years. Complaints come from both sides of the political aisle. These complaints threaten the trust that Americans have in banking supervision and potentially destabilize the banking industry. Everyone interested in government should consider reforms that address the supervisory discretion and secrecy that allow debanking to continue.
Thank you, Ms. Hill. I love the analogy on the manufacturer, too. I'll be back with some questions about that. Our next witness is Ms. Scamma. Currently serves as principal at Multiple Use Advocacy, where she helps advance responsible energy, ranching, mining, timber, recreation, and other multiple use issues on public lands. She also helps companies navigate EPA air and water issues. Previously, she was president of Western Energy Alliance, which focuses on energy and public land issues in the 13-state Intermountain West of the United States. She has testified before several congressional committees on energy and environmental topics and is regularly quoted on Western issues in the national and regional media, including the Wall Street Journal, New York Times, Fox News, BBC, E&E News, National Journal, and Denver Post. I should have just said a lot. Ms. Scamma, you may begin your opening statement.
Thank you, Mr. Chairman. Ranking Member Cortez Masto. I appreciate being here today, members of the committee. That was a good primer on financial regulation. I don't have that background, as you noticed from my bio. I really got into this issue about 8 years ago when the Bank of the West, an affiliate of BNP Paribas, decided that they were going to drop all oil, gas, and oil, coal, natural gas from their portfolio, creating quite a stir on the west slope of Colorado, where I'm from. Not the west slope, but I'm in Denver. And we noticed the impact with my members, particularly with the small independent producers in the Rocky Mountain West, who then had to scramble to find other banking options. We've seen this, Mr. Chairman, I like the way you your opening comments where you outlined some of the causes of this. I look at it as the activists working hand in glove persuaded the regulators under the Biden administration, and they approached it with this whole of government approach to use every financial regulatory lever to debank, decapitalize my industry. And of course, what that does is raise prices for consumers ultimately, as my members couldn't find lines of credit or their cost of capital was so much higher, particularly the smaller companies versus many of the larger companies who always can absorb regulatory cost. So we had a situation where smaller and larger companies as well for a while were facing debanking pressures, decapitalization pressures, and it continues to this day. Some of the large foreign banks have not returned to the oil and gas industry. Certainly some of the larger banks in the United States have had the pressure come off of them. Obviously, President Trump's leadership has been very key for that, but we're still seeing debanking effects in the oil and natural gas industry. And again, ultimately, that raises prices for consumers. So I spent the last 5 or 6 years, particularly under the Biden administration, really looking into this issue, though I don't have that deep regulatory or financial experience that Dean Hill does. I was actually learning quite a bit. I appreciate that and look forward to hearing more. But I tried to keep up with it for a while. Yeah, I think I responded to 8 different comment periods, and each one highly complex. And I could barely keep up during the Biden administration's whole of government approach with all of the financial regulation directed against the oil and gas industry. So, Mr. Chairman, I really appreciate your bill. I urge the committee to move forward with it, particularly where we can ensure that financial regulators don't have the ability to repeat that cycle of debanking and decapitalizing the industry in the future. And the reputational risk was a very real thing. That was, we saw companies harassed. We saw shareholder activism where, companies were harassed with their climate change regulations, with disclosures. Luckily, President Trump has beat a lot of that back. But again, to ensure that we don't see a repeat of the cycle, this legislation is very important, and I hope the committee does indeed move forward with the bill. Thank you very much.
Thank you, Ms. Gamma.
Thank you. Tyler Klimas, I so appreciate him appearing before the subcommittee today. He is a constituent from Nevada. He grew up in the state and knows our businesses, governments, and the people there very well. He currently serves as the principal of Leaf Street Strategies, where he works with private companies and governments on cannabis regulation. Prior to that, he was the first executive director of the Nevada Cannabis Compliance Board. In that role, he redesigned Nevada's cannabis regulatory regime following Nevada's legalization of adult-use cannabis. Mr. Klimas also served as a founding member and president of the Cannabis Regulators Association. He is someone that my office has relied on to understand the cannabis industry in Nevada, and I thank him for traveling all the way from Henderson, Nevada, to be with us today. Mr. Klimas, if you would like to give us your opening statement.
Thank you. Chairman Tillis, Ranking Member Cortez Masto, and members of the committee, thank you for allowing me to be here today, and I appreciate the opportunity to testify on the issue of fair access to banking. Because this hearing is about ensuring fair access to banking, I believe that no discussion of this issue is complete without addressing the challenges facing the cannabis industry and the role solutions like the Safer Banking Act can play in addressing them. As Nevada's former chief regulator overseeing a $1 billion retail market, my job was to implement compliance programs designed to prevent diversion, ensure product safety, and protect public trust and confidence through transparency across the industry. Each of those responsibilities was made more difficult by the lack of access to traditional banking services. Today, 40 states and territories have now developed regulated cannabis markets, supporting hundreds of thousands of jobs and generating billions in state tax revenue. Yet many of these state legal businesses continue to struggle to access basic financial services. As a result, they remain cash-intensive, creating a significant public safety risk and an economic burden on small and medium-sized businesses that already operate on thin margins. The Safer Banking Act would provide the certainty financial institutions need to serve this growing industry while also making communities safer and improving transparency and accountability in the marketplace. More than half of Americans now live in a state where adult-use cannabis is legal, and the industry is projected to generate over $44 billion in revenue in 2025. Despite this growth, banks and other financial institutions remain reluctant to serve cannabis businesses due to ongoing regulatory uncertainty. While some banks and local credit unions do service legal cannabis businesses, that universe is small. Even when financial institutions do enter the space, they take on risk due to that uncertainty. Risk that results in high administrative and compliance costs, costs that are then passed down to the cannabis businesses in the form of high fees. These challenges are not limited to cannabis operators alone. Businesses that support or engage with the cannabis industry, like industrial suppliers, agricultural vendors, commercial and industrial real estate firms, and even automotive dealers, fall victim to many of the same banking challenges because of their association with cannabis. Even state governments have challenges with banking if they are one of the 40 states that have a cannabis program. In Nevada, our regulation of cannabis risks disrupting the state's entire relationship with its banking partner, forcing us to spend countless hours to find creative workarounds and issue guidance to the industry on what language to avoid putting on payment notices. Instances like these are common in other states. Without greater engagement by financial institutions, we are also left with a growing lack of insight and transparency into licensed operators in state markets. This, too, directly impacts public safety. In Nevada, we drew from our world-renowned gaming regulatory model to implement one of the nation's most comprehensive cannabis investigations divisions. We understood the importance of not only compliance, but of understanding exactly who was operating in our industry and ultimately who was profiting from it. While states enjoy incredible insight into supply chains through mandatory tracking systems, reconciling that information with the financials of companies that have difficulty maintaining banking relationships or deal mainly in cash makes that job extremely difficult. As a result, this creates opportunity for bad actors to exploit this lack of transparency and challenges in oversight simply because we have yet to fill this policy gap. I understand the desire to put effort behind a more comprehensive federal regulatory framework for cannabis. That is a goal shared with most in this industry. But each day we wait on common sense measures like the Safer Banking Act, we're hurting businesses, causing friction for employees trying to earn a living, and providing cover for bad actors to persist. Creating a level playing field and ensuring fair access to normalized banking services allows legal cannabis businesses to realize cost savings and efficiencies, just like any other business. In cannabis, cost savings and efficiencies for operators allows them to be more competitive in pricing, a key component in addressing the illicit market. As long as the illicit market operators are able to exploit the unnecessary difficulties that legal operators face, we will continue to see unsafe and untested product available to consumers and a significant loss of tax revenue to states and the federal government. To conclude, allowing clear and certain access to the financial system for state legal cannabis businesses does not amount to the federal legalization of cannabis. Legislation like the Safer Banking Act enhances and strengthens regulatory oversight, and it allows financial institutions to rightfully serve businesses in their communities without unnecessary fear or uncertainty. Thank you again for the opportunity to testify today, and I look forward to answering your questions.
Thank you, Mr. Klimas. For the record, Senator Cortez Masto, absolutely agree with everything you said about the banking situation in this industry. I mean, we've got to realize that 2/3 of the states have legal cannabis operations, either medicinal or recreational. I'm a free market capitalist. Whether or not I agree with a given market activity, if it exists, the federal government should exist to regulate it and also get a lot of bad actions. The only reason why I'm not quite there on the Safer Banking Act yet, Mr. Klimas, is I see that as a forcing mechanism for a more comprehensive framework to get things right. I mean, from crop safety, a USDA regimen, not unlike the tobacco industry, to the FDA, to flavorings, to advertising. You see some of these advertised out there. I said they're called Stonios. It looks like a Oreos package, but they're gummies. I mean, we've got all this stuff is wild, wild west right now, and we've got to get it under control. Now I'm going to get back to the main topic here. Ms. Hill, you did a great job on your opening statement. I'm sorry I cut it short. I was learning as you were going through as well. But have you had an opportunity to review our discussion draft, Bill?
I have.
Can you give me any insight into areas that, good, bad, or ugly?
So
I don't know if they use that rubric here, but we'll use it for the sake of argument.
I wholly agree that Congress needs to act on reputation risk. Some amount of discretion is really important in banking.
What are problems? Let's cover any kind of problems or concerns you have with the bill.
Well, I guess I think how to respond to state fair banking access rules is a hard question. So I think, is not ideal to have 50 different states have 50 different fair access rules for banks because that makes it very hard, especially for banks that operate across state borders. On the other hand, I think that it's difficult to draft a law that recognizes that we are a nation of thousands of banks and credit unions, and each of them have their own separate business models and business purposes. We can't expect a bank that operates in rural Wyoming to have the same diversity of customers as banks that operate in every state.
That's a good point. One of the things that I've said, if you want to charter a bank to serve, I'm not going to list the topic, but list an unseemly market that happens to be a legal market, and that's all you want to focus on, I have no problem at all with doing that. And so we need to make sure that if it works as a business model, the problem that I've had a number of the GSIBs, bigger banks in my office, and I've told them all the same thing. If you start acting like a politician, expect to be treated like one. And so my concern is more activists, shareholders, and board members forcing a CEO to do something that he or she probably doesn't want to do. And in some respects, I think that they're violating their fiduciary responsibility to the whole of their investors when they do it. Ms. Scammer or Ms. Dean or Mr. Klimas, I was going to talk about cannabis, but if you want to weigh in on this one, you can weigh in on this one too. But Ms. Scammer, what do you think about that?
Yeah, I mean, that's what we saw in the oil and natural gas industry. We had...
And what happens when the oil and gas industry has all of that uncertainty? What happens to investment and the underlying health and hygiene of the industry?
Well, we saw many years of underinvestment in oil and natural gas, and now we're bearing that with all the need for energy, with data centers, AI. Suddenly, we need all this new energy, and And it
has the perverse consequence of putting us further away from an energy transition, which is going to happen at some point. But we're not making investments in modernization because we can't even figure out if we can get a loan.
Right. I mean, it had serious implications for the infrastructure for AI now, and we're scrambling to catch up as a country.
I'm gonna ask a follow-up question, so I'll go to Senator Cortez Masto.
Thank you, Mr. Chairman. Mr. Klimas, I had mentioned that currently there's a proposal to reschedule cannabis, right, and to a Schedule III from a Schedule I. Can you expand on why we still need, even if that happens, why do we still need to enact specific cannabis banking legislation such as SAFER?
So, the protection for banks or the legality for banks in this perspective is not tied to the scheduling. So there is indication from the administration that they may be looking towards directing agencies to move cannabis from Schedule 1 to Schedule 3. That impact on state markets, it does not impact the state's legality of the market and the way that they operate and sell products. They're still illegal. They're not FDA-approved products. So that doesn't do anything for the risk with banks. And current financial guidance, the FinCEN guidance from 2014, would be the same type of guidance. So it would still be illegal commerce at the state level, whether it was a Schedule 1 drug or a Schedule 3 drug.
Yeah, thank you. And I appreciate the chairman's comments with respect to the market as a whole. And I noticed you might want to respond to some of it, because let me ask you this. Just like the patchwork of state laws that you have just addressed, technically, when it comes to cannabis, each state right now, because the federal legislation is there making it illegal, each state has its own regulations, right? How would you address some of the concerns the chairman talked about with gummies and the regulation of some of the flavoring? And is each state different? Is there a standard that we should be looking at? Can you talk a little bit about that?
Sure. So, yes, we have a patchwork of regulations. Each state takes a different approach. And I think overall that is recognizing a lack of standardization among this industry over 40 states. There are groups, the Cannabis Regulators Association, which I helped found. They do really great work on trying to standardize that at the state level. But each state legislature has its own opinion on how they want their programs to run. And so we're left with that patchwork. And Chairman, I agree with you. The ultimate goal here is to create a global regulatory framework that inserts federal agencies like the FDA in to do research and to help set those standards. My fear is that that's going to take quite a bit of time. Maybe a move to Schedule 3 is momentum, and that would be positive, but I worry about what happens, not only what happens to the small and medium-sized businesses in the cannabis industry, but what happens to bad actors that have found a place in this industry while we wait for that. But I certainly appreciate that and agree with you.
And then would you address the cash-intensive nature? Because that's still a concern, and that's what this Safer Banking Act is really trying to get at this one small piece of it, and the concerns there about public safety when it comes to cash-intensive businesses like cannabis businesses.
Absolutely. And so as a former regulator, our job was to protect the public health and safety. That was our job, and we did that through transparency in our operators and transparency in our industries, or transparency initiatives. Most state regulatory bodies have a great understanding of the operations of cannabis businesses. We do that through seed-to-sale tracking, which is a requirement. So we know product from when it's planted to when it's sold. Also, most regulatory bodies have a really good understanding of ownership structures. There are pretty strict ownership requirements to try to look out for hidden ownership. What we don't have the most insight into is the financials, especially when we're moving large-scale cash-based transactions back and forth. And so, what the Safer Banking Act would do is bring financial institutions, give them that protection and that safe harbor, and bring them into the fold on a more comprehensive basis. Because financial institutions are the ones that should be looking out for this. They're the pros, the professionals at tracking money, sending those reports on Know Your Customer and anti-money laundering. That, in combination with the work that state regulators have done on operations and ownership, that's really how we get insight into the operators and make sure that we're protecting the public safety aspect of this.
Thank you. I know my time is almost up, but I appreciate your comments and being here.
Senator Kramer?
Thank you, Mr. Chairman. And we should do more subcommittee hearings because I like this rather intimate opportunity. And I'm hoping for a couple of rounds like you. Because frankly, everything I was prepared to ask you all is secondary to everything that you've inspired in me. A few things. First of all, Ms. Hill, has your paper for Texas A&M, has that been published yet?
Not yet, still working on it.
Okay, so I read the interview, and it looks fascinating, and I appreciate your testimony a lot. One of the things I'd like to do right up front is, you know, the OCC has published its preliminary findings on debanking, and it's a very short document. We're waiting for the full one, right, to be done. But if it's okay, Mr. Chairman, I'd like to submit it for the record without objection. Okay, thank you very much for that. I'm looking forward to that. So where to begin? You know, I might just start where we ended up on the cannabis thing, particularly in light of what you had said about the Wild West. Our recent experience in the Senate of dealing with the appropriations bill that dealt with a simple hemp issue in one state was a good example of what happens if we don't take a thorough look at, you know, at the whole industry. Now that said, I'm with you on fair access. I mean, I think fair banking, I think we have to be careful. We just have to acknowledge the reality in our states, right? And so, and this, by the way, we're not supposed to do a lot, but interstate commerce is one of the things that the founders actually thought we should have something to say about. So anyway, I'm just wanted to say that up front. But your point, Dean Hill, about the way I summarize it is, as bad as bad regulation is, bad regulators are worse. And as bad as bad regulators are, uncertainty is even harder. And the reality is that reputation comes from rumors and rumors of rumors as much as it does from bad regulation. I think that's kind of what you're saying, is that if we don't put some guardrails on the debanking side, we leave bad decisions or decisions up to a variety of views, political views and otherwise, both in the industry and with the regulators. Am I on track here?
Yeah. In 2019, I did a study on just reputation risk. So I looked at the way the bank regulators use reputation risk, and almost always it's ancillary. So they find a bank that engaged in money laundering, and they say, you shouldn't have engaged in money laundering because it's illegal and it causes reputation risk. Or they find a bank that opened unauthorized accounts, and they say, you shouldn't open unauthorized accounts because it's illegal and it causes reputation risk. So in those instances, reputation risk isn't really doing anything. We might 100% agree that it exists, but regulators don't need that tool to stop that illegal behavior or that risky behavior. Reputation risk becomes troublesome when it acts all on its own. So when it's just reputation risk, when you can't point to a violation of the law or increased financial risk, that's when regulators can use it just to punish people for political reasons. And in that case, it's not doing anything to make the financial industry safer. It's just politicizing the regulators, and that's what's wrong.
I'm going to ask an opinion question here that wasn't in my notes either, but it occurred to me. There are a lot of people who think that, and I think you're maybe one of those, or at least alluding to the fact that regulators have given mixed signals based, because of the lack of the guardrails. Some people would submit to you that the regulators are sort of a useful excuse for bankers to do what they want anyway. And I might ask maybe each of you if you think there's some truth to that, because we're seeing bankers who, on one hand, especially the large banks, have said we're never going to do that, and then there's a change in administration. They say we didn't really say that, and then of course they wait for later, and then they go with the political winds. I mean, do you think it's the banks as much as the regulators?
I mean, I think it's very hard to know, and that points to another problem, right, which is the secrecy surrounding financial supervision makes it very easy for both the regulators and the banks to point at the other and cast blame, and we never really know who's telling the truth.
With so little time left, I'll yield and then go for a second round. All right, thank you.
Ms. Hill, I'd like to think I've established a reputation of trying to see both sides of the issue here in the time in the Senate. Obviously, Republicans are going to talk about choke point. It was, to me, despicable. So I want you to start thinking about an example. I want to ask another question, but I want to give you time to think about any example where you think in a Republican administration there was an overreach, if you can find any. In the same vein, maybe not at the scale of choke point, but while you're trying to think about that, I actually think that a select group of members of Congress need to be able to have access to confidential supervisory information. I think the mere fact that we would have that ability would have a calming influence on over-examination or over-supervision. Do you agree with that?
Yes, I think that Congress ought to have some oversight. Of course, I would like it to be a little broader so that people who research and write in the area can have access to financial information perhaps
baby
years
steps.
later.
I mean,
Yes.
the fact that it's extraordinary that I, as a U.S. Senator, would just like to see the confidential. We get to see top secret classified briefings anytime we want to down in the SCIF on matters of national security. But I can't necessarily see if I suspect a supervisor is over-supervising. I can't get access to that information today as a member of the banking committee. Seems a bit silly. Even if we lift it up to the chair and ranking member, someone has to have access. And it sounds like you agree with that, Ms. Gamma?
Yeah.
I don't know that I have a strong opinion on that. I do feel that a lot of the reputational risk was generated by activist shareholders. And so I do have some sympathy for some of the financial institutions because they were getting a lot of pressure as well. It was just that political theory that we were going away from,
Well, the
from
flip
oil and
side,
gas.
even when you get out of the debanking issue, if you take a look at Silicon Valley Bank, their failure, I'd love to see some of the supervisory notes in that to kind of weave together exactly how that happened. It was obviously a failure by the management, but there's also a little bit of suspicion in my mind about the examiners not doing their job enforcing the issue. So I gave you a few minutes, Ms. Hill. Can you think of any example of where a Republican administration or Republican Congress may have overreached a little bit?
So the last citation in my written testimony is to a news article where the author is making the argument that the current Trump administration is doing the same thing to Antifa.
That's a very good point. Thank you. Senator Cortez Masto, you have any other?
Just one quick question, Ms. Hill. Thank you. First of all, I think this is a great hearing as well, and I'm always trying to find the balance. Is there any scenario where you think reputational risk should be utilized, either by the regulator or by the financial institution?
So I think it's fine for the financial institution to think about it. They're better positioned to understand what their customers, their shareholders, their employees are going to think about the actions that they take. But government regulators don't understand what the customers of specific banks want, especially if they're small banks operating in small markets.
So how do you bridge that gap between if a financial institution has that opportunity to decide reputational risk and say, oh, this is too risky, we're not going to bank with you, and then how do you, if a regulator doesn't have access to that information or understand what is going on there, how do you bridge the gap between the regulator and the financial institution making that decision?
So I think that a financial institution can make decisions about reputation risk, but I think that the government supervisors shouldn't weigh in on that, right? I think that government supervisors are best when they're focusing on credit risk and interest rate risk primarily.
So let's say we go back to, I think with is it Gamma? Is that how you pronounce it? It's Gamma, thank you. So what if, I almost feel like I'm an appellate court judge, but let me just ask you this. What if you have a financial institution that, because of shareholder activity, says they're going to use reputational risk to the chagrin of oil and gas? Should a regulator ignore that or not weigh in to say no and right the ship and say, no, you can't do that, it's not appropriate? Or you just think the regulator should not be involved at all in that determination of reputational risk?
Well, I mean, I think banks have to take a close look at how much they want to pander to shareholder activists. But I guess, yes, I'm more of a free market person who would tell the regulators to let the bank make the decision for themselves.
No matter how, if it harms an industry, because the politics is getting involved or shareholder activism is getting involved, the regulator should not be engaged in that at all.
Yes, that's what I think. I think part of the reason I think that is because I would think differently about it if our banking system looked like Canada's or the United Kingdom's or Europe's, where we have a handful of large players I think it's harder in the United States to say that we're going to have capture by a few activist investors when we have thousands of financial institutions. Now, once we get to the really large banks that essentially have market power in various areas, it gets to be a harder question. But right now, I think that I would leave hands off for the regulators.
Thank you. Thank you.
Well, along those lines, so Senator Tillis has talked about his bill. I have fair access to banking, which is very similar. He's a co-sponsor of mine as well. But it does, the threshold is 10 billion instead of 100 billion. And I think there are a lot of industries that bank more at that level than at the high level. And I just think that penalize is a hard word, but I think you have to have a penalty, if you will, for denying services on anything other than empirical data that's consistent with the bank's, the traditions and establishing partial risk. Because if you don't, then you are just subjecting to political whims. So maybe all of you, from your perspective, would a penalty or enforcement mechanism help hold those banks accountable? I thought, frankly, your discussion, Ms. Sagma, about this suddenly explosion of demand for power after all this debanking and the lack of investment in reliable energy is kind of an interesting circumstance that could have been avoided. But with that, maybe we'll start on this end and go this way on that question about would a enforcement mechanism help hold the banks accountable and provide for better guidance?
Senator, I appreciate the question. This is not my area of expertise, so I'll go ahead and pass on this.
Kathleen.
Yeah, I somewhat agree with the market access or the free market argument. And in some ways, we're seeing the pressure come off because of those free market reasons as well. I forget the names of the two organizations that spawn all these shareholder activism. Mm-hmm. I know President Trump has taken action on it. Perhaps that's a better way to go about taking off some of that shareholder activism. I think some of the publicity, the states did an excellent job, Texas, West Virginia, Oklahoma, in raising awareness by saying, if you debank coal, oil, and natural gas, then we're not going to do business with you. And I think that was really a pivotal. So there are other ways maybe to tackle it as well.
It might be a little harder in places like Wyoming and North Dakota and South Dakota, however, where you don't have that kind of market power. Let me put it another way, and then Dean Hill, you can answer. Does prohibiting debanking imply a mandate to bank? In other words, I think the point, your free market, more libertarian point is accurate, although I would also say that banks are awfully subject to federal oversight and some, in many cases, federal support. I mean, too big to fail is a pretty good example, or FDIC. But does prohibiting debanking have to imply that you are required to bank, which I think should not be the goal. But does that make sense? Yeah, each of you want to try?
Yeah, yes, it does make sense. It's a fine line at some point. To me, the biggest issue over the last 5 years for my industry has been making sure the regulators can't, use all these levers. To me, that's the really important part.
Dean Hill, similar?
Yeah, so it's certainly true that banks benefit from government supervision and government insurance, which they pay for, right? Right? So at least in theory, you should be pricing that into your bank's model. But the truth of the matter is that there are customers which it is just difficult to profitably bank. And that can be people who overdraw their account or bad credit risks, or it could be marijuana businesses where the compliance burden is just so high that when you price that into the cost of the account, it becomes prohibitive. And so, I think that there is something of a line between debanking and being forced to bank, but you've got to be careful about it because it will be difficult, very difficult, for banks to bank some customers.
I'm glad we clarified that. But great discussion. Thank you. Yeah.
I'd just like to thank everyone for being here, Mr. Chairman, and for the hearing today. I'd like to submit 3 letters of support for their Safer Banking Act for the record. They're from the Independent Community Bankers of America, the American Bankers Association, and the U.S. Cannabis Roundtable that all support the Safer Act. Thank you.
I want to be clear on the debanking phenomenon that bothers me is when somebody from big government tells you you've got to debank an industry. As I said, I think in my opening statements or my opening questions, if you can build a bank with a market focus on people who own purple horses, great. If you can return value to your founding members, I'm guessing it'd be a small bank, and to your shareholders, I don't believe that government should exist to determine that. But we have seen in red states and blue states what I think are debanking activities that are driven purely from an ideological perspective, and I think that that's a mistake. And I think that's really underpins what we're trying to do with the Access to Banking Act. But Sarah Kramer, I'm glad you were here today. I kind of create a debate club, sort of more discussion content in my committee hearings, and I'm glad that you indulged us. I want to thank all the colleagues for being here and to the witnesses for sharing your expertise. The Trump administration, I believe, has taken meaningful action to curtail debanking across the federal prudential regulators. I strongly support these efforts. Yet, it remains critical that Congress addresses both financial institution-initiated and regular-initiated debanking so that the future administrations cannot engage in the same malpractice. So thank you all. To all for providing help and insight thus far. I appreciate your feedback and line by line on the Ensuring Fair Access to Banking Act of 2025 discretion draft. This concludes the hearing. For senators who wish to submit questions for the record, please do so before 1 week from today, December 23rd. And for the witnesses, you have 45 days to respond, and we would appreciate your response. Thank you all. This hearing is adjourned.